Okay. Good afternoon. I'm Kathy Neifeld, one of the principals at Agency One. On behalf of my partners and our amazing Agency One team, I am thrilled to welcome you to our biweekly webinar series. This is the 11th webinar that we have hosted this year, and all of the webinars, with the exception of one, have been recorded and can be found on either the Agency One website or on our YouTube channel. If you are looking for information on asset protection and estate, income, and gift tax planning under President Biden's administration, digital marketing tools, strategies, and resources that you should be using to help drive more business, a premium financing update, underwriting information, a current economic update, information on whole life carriers and opportunities in the whole life marketplace, information on Proformex, an in-force policy monitoring system, or perhaps are interested in an industry perspective from the president and CEO of John Hancock Life Insurance Company, I encourage you to access these webinars. The speakers are renowned industry experts and have included nationally recognized estate planning attorney Alan Brown and advanced markets consultant Randy Zipsey, digital marketing expert Samantha Russell, the Senior Vice President and National Director for Premium Financing at U.S. Bank, Taylor Miller, economist Ani Bonbasu, Brooks Tingle, the President and CEO of John Hancock Life Insurance Company, and our very own superstar underwriting team, led by my partner, Dennis Bartos. And there are other speakers as well. For those of you that are new to Agency One, a brief introduction. We are a very high-touch exclusive BGA. Exclusive, what does that mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs, like disability or life settlement or standalone long-term care, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner, Dennis Bartos, and advanced markets and case design departments led by my partner, Gonzalo Garcia. If you want high-touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your BGA. If you would like to learn more about us, the Agency One 100 platform, and how you can become a part of it, or if you have a case that you would like to discuss, please reach out to us. I have some additional important announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now on to today's webinar. Price increases, product changes, and conversions. Now what? The prolonged low interest rate environment has forced carriers to reevaluate pricing and product offerings. We are going to discuss these changes and talk about opportunities that you should be pursuing. I am thrilled to be joined here today by my partner and our head of advanced markets, Gonzalo Garcia, or as we refer to him, G. And he's also a competitive volleyball player, for those of you that didn't realize that, along with our head of case design and illustrations, Ed Stark, or as Gonzalo commonly refers to him as Starky, and Ed is also a mean mountain biker. Gonzalo and Ed will try to respond to any questions that have been asked at the end of the presentation, so please submit your questions through the question or chat feature at the bottom of your screen, and we will be monitoring them as they are submitted. This session is being recorded, and I am now going to turn this over to Ed and Gonzalo. Take it away.
All right, thanks for the intro, Kathy. Thank you guys. Before we get started, the first thing I'd like to do is just take a moment and thank everyone for attending today and spending the time with us. Also, Kathy mentioned that, at the end, we'll have some time to answer some questions on some of the things that we're going to talk about, or anything that you guys want to bring up around this topic. So anything you want to add to the intro, Gonzalo?
No, just thank you all for being here and welcome. Go ahead, Stark.
Awesome. Okay. So, let's start by taking a look back at GUL over the years. Approximately 15 to 20 years ago, GUL was the go-to product in the marketplace. I remember doing tons of 1035 exchanges from underperforming UL and VUL contracts. The thing with those products, the original UL and VULs, is that when they were sold, they had extremely high crediting rates and charges. So they really underperformed for a certain amount of time, which really made them not as competitive. GUL became a perfect fit for these. When you rolled those 1035s in, you got 4 to 5 times leverage on the death benefit. You were able to move them out of something that had a lot of variables into a guaranteed fixed product. And, it was something that was very popular back then. The downside of the GUL was that these contracts had little to no cash value, and they're very inflexible on premiums and funding. I mean, you couldn't pay late and you couldn't pay early. I mean, you basically had to pay everything as scheduled. And going back to that pay early, how crazy is that? If you pay a premium early, it would impact the guarantees of the contract. So even with those concerns, I mean, GUL made sense for a lot of the deals that were being put together back then, and the clients were happy to get a guaranteed policy. Another thing with GUL is back in the heyday that almost every carrier had one. So every carrier in the market had one, and not only did they have one, they all fought for position. They all wanted to be the number one in the market. They were fighting for market share. It was very competitive. And as we all know, times have changed. And I'm not sure any carrier right now wants to be the number one lead GUL carrier in the market. So, in talking about that, let's say, well, so what happened to GUL? What happened from back then to today? And Gonzalo wants to take this, or G, as Kathy said, on the phone. We'd like to talk a little bit about that.
Well, Ed, it's if you've been doing this as long as I have, you know that over the years, we've had almost distinct decades of product in vogueness, if you will. From the days of UL with current assumption UL with really high interest rates back in the 80s to variable to then the GULs and now index, right? And the reality is that the interest rate environment since 2008, which really during the economic recession kind of grabbed hold of the economy, and that we've been pushing interest rates down for 12, 13 years now, is really beginning to have an impact on the insurance companies. And there are a number of things that are listed on the board here, but things like accounting for reserves and the interest rate pressure are really the two things that have really hammered the industry, and GUL has suffered along with it. And, Ed, you're going to talk to us later. You said every carrier had one. There's maybe 10 or 12 carriers with any reasonable market share that have a GUL today, and that number seems to be diminishing. And every time we turn around, every week goes by, we see more companies getting out of the guarantee space. And if they're not getting out of the guarantee space, they're cutting back some of the guarantees or having massive price increases. I mean, we just saw one company last week that announced a 17% increase on their GUL portfolio across the board. Ed's going to talk about some opportunities that result of that, and we've got another company that's announced a price increase for June. And we have a number of companies that have gotten out of GUL altogether. I mean, this started, not to pick on anybody in particular, but Equitable or AXA at the time, and John Hancock kind of got out of the GUL space and went into the current assumption. Then we started seeing IULs and GULs with life expectancy guarantees or maybe guarantees to 90. But the real important part of this whole conversation is, the insurance companies now, I always hear Dennis, our business partner, telling me, well, it's a $400,000 premium. I got to get a good offer, and it's some sort of guarantee product. You can't think of things like that anymore. I mean, the insurance companies have too much premium coming in. And if you think about what they're investing in right now, and the benchmark for those, the bellwether is the 10-year treasury, they're investing at 1.6, 1.7%. And portfolio yields have been coming down over the last 12 years, and we've got portfolio yields now in the 4s and 5s if you're really lucky, maybe in the high 3s. And that's an impact of, you bring in $100 million of premium today, you're investing at 1.5% or 1.6%. You've got maturing bonds and that rotating bond portfolio on maturities. Every time you've got $100 million worth of bonds you bought 15 or 10 years ago and it's maturing, you're reinvesting at 1.5%. So those portfolio yields are going to continue to come down. In addition, there's been a huge amount of regulatory pressure on shoring up reserves. And as a result of 2008, we had some insurance companies and other financial institutions that wavered a bit, so that there was a lot of pressure and regulatory pressure to continue to shore up reserves. Excuse me. So what we're seeing here is products being dropped, rate increases, cost increases, and the big question is now what and where are the opportunities? And I think Ed is going to spend the rest of this conversation talking about that. But you know, the pressure that if you come away with nothing else from this conversation, the pressure that the insurance companies are under today in this low interest rate environment is not only impacting pricing, but their financials, staffing, and all sorts of other resources. So the world has changed, and I don't know that anybody really sees interest rates going back up in a big way anytime soon. So that's just something we're going to have to live with. So we have to get into the creativity of using some of the new products that are coming out. And there's a whole lot of that. And I'll leave you with one last thing. Of course, everybody knows that IUL has been the product of choice for many, many advisors over the last 10 years or so. There are, you've probably seen this, there are continuous cap drops that are impacting the IUL space. We've seen one company increase caps 3 times in the last 6 months. That is going to continue to happen because IUL, it's not an investment, right? It's still a fixed income portfolio. And what's giving them their options budget to buy these indexes is what their portfolio yield is. So again, as you see those portfolio yields coming down, you're going to see pressure on caps and they will continue to come down. So, you know, that's just kind of the world we live in right now. We're going to have to get used to it. There's a lot of companies now really moving towards the VUL space. You know, every time we have a wholesaler come into our office or talk to us, it's all about their new VUL product. Everything is VUL now. Well, you know, VUL doesn't have the same kind of pressures that fixed portfolio products have on their financials. And they're just making moves to products that can give them some ability to survive in this environment. And some of them, uniquely so, and Ed will talk about this as well, are providing some amount of guarantees. So, you know, we've got some real opportunities here in terms of a product change and a product shift. And Ed will talk to us about that for the rest of this session. So Ed, back to you.
All right, cool. Thanks, Gonzalo. You know, so it's always great to look back and say, hey, I remember we sold this, we had this, but it's really important that we talk about what we have today and almost to think a little bit ahead and say maybe what we would have tomorrow. And you know, none of us know that for sure or what it would be, but to know that if things are changing and continually this stuff's happening, you want to be aware of what's going to happen or be a little bit aware of down the road it's probably going to keep going that way, or maybe even if it stays the same, is that the best it's going to be? So you just have to kind of keep that in mind. So looking at product availability today, you know, GUL is still available as a product, and there's still a few carriers that sell the true version of the product. I mean, we've seen countless products pulled from the market over the years, and the ones that are left have had price increases, like Gonzalo mentioned. A few have actually had multiple price increases in the same year. Single pay and short pay GULs, they don't have the same pop that they used to have. So that large dump in or that 10 pay design, you might only get leverage of maybe tops 2.5, 3 times leverage on that. And the older ages are more impacted than the younger ages. So, you know, GUL isn't going to always be the best case where before you'd say, hey, GUL, I'll just run it and I'll put all this in there and let's make it happen. You have to look at what you're trying to do. You look at the design and how you're coming to the table with premium and 1035 and decide on what type of product you're going to use. And there's GULs or guaranteed type products that aren't GUL that you can use, like Gonzalo mentioned, variable. There's IUL, and some of those look better on short pay or dump-ins. The bridge products that we're going to talk about on the call here, those are using UL and indexed UL chassis. And finally, we're even going to look at the original life insurance deal. I call it the original whole life insurance. So a GUL, we'll talk about guaranteed products that are still available. As you can see on the slide, Agency One has about 14 carriers that still have a UL or an indexed UL product that can be run with guaranteed premium. You know, it's still out there and there's still a good amount to pick from. But a few of these 14 products, you can only guarantee to, you know, minimum ages of like maybe 95. Some of them have to be guaranteed to 100 and some have to be guaranteed for lifetime. And then a few of those, you might be able to do a shorter guarantee that you might be able to do a step guarantee or something like that, but those are even harder to find. So each product has its own design requirements, which we can walk you through on your next case. So, without breaking down each carrier individually. And speaking of cases, I recently worked on one with an agent who was just really comfortable with, he wanted a GUL type product and, wasn't really a fan of index, but we showed him a guaranteed index UL product, and it was not a younger client. But the interesting thing was that this product priced the cheapest with the same guarantee to age 105, but it still had an interesting cash value that ran all the way through the 90s. So if it did perform, there would be some cash. And again, there's problems with taking cash out of guaranteed contracts, but to have that as an option makes it a little more attractive than just a straight GUL that doesn't have anything in it. And again, Agency One, our design team, me, Herbert, and Craig, or Herbert, Craig, and I, when we run these, we're going to add that into your scenario so you can at least take a look at it.
So Ed, I think that's an important thing to just take a quick pause on. Oftentimes we get calls from advisors that say, I want a guaranteed of 110 or 105 or 100 or whatever that is. Mm-hmm. And, a lot of times you guys are running these illustrations as requested, but you're providing a few options in addition to as well. So you may be doing a guarantee to 90 or a guarantee to 100 with some of these products that have cash value. So I would just say to the folks on the phone, when you get an illustration or a illustration spreadsheet or a benchmarking, you're going to see not just the GUL that you've requested, but you're going to see another few options. And I think you need to consider those. So you may want to take a look at it.
Yeah, and it's worth breaking down the illustration or at least having that conversation, because you can look at the GUL Premium and we'll see some good examples of why we should do that. Actually, we'll talk more about that later in the presentation. But, just keeping along on this, again, so what about the guaranteed VUL options? With what they call a GVUL, you can offer a client a guarantee all the way out to 121. But the benefit of it is that you can invest it into different funds that they have available and maybe grow that cash. So you'll have a cash accumulation and a downside protection of the guarantee of the product. Now, again, there's always, with guaranteed products, there's issues with taking cash out. Depending on, when you do it, it may affect the guarantee. But it is an interesting product because these design extremely well on short pays and dump-ins. And they do sometimes have limits, like some might say you can only put in up to 500,000, or some may be capped at $1 million. But again, they'll actually illustrate better on the shorter pay scenarios. But when you have a level pay, they're going to be more expensive than the traditional type GUL products. They're just not set for that. And again, as a friendly reminder, to sell this product, you would need a Series 6 or a Series 7 license. So you do have to have something like that in a relationship with a broker dealer. All right, now on to bridge products. So you probably heard me speak of these previously. There's not an official definition, but really it's a product that's either a UL or an IUL option that can be designed with some type of life expectancy guarantee. And when I say life expectancy guarantee, we're talking about 85 and above, a later guarantee, not just that built-in 10-year that you might get. It's something that goes further out. And, this helps a client get a more competitive premium by giving up some of those later guarantees that go from the late 90s to the 100, 121 kind of thing. So it's a trade-off on that. They're all designed around cash value solves, and they need to be managed more closely than a GUL. But basically, you're able to still keep positive cash. It keeps the policy in force. So by making adjustments along the way or changing premium, you can keep these in force. And what I want to do is show you this example that's on the slide. I mean, take the fact pattern there, male 50, preferred, 1 million with a $25,000 1035, and we're solving for a premium. Your GUL to 121 premium is $11,993. All right, so if you pay that every year, you have fully guaranteed coverage no matter what happens in the contract. If we take one of these bridge product ULs, we do that same solve for $1 cash at 121, the premium can drop down to 10,664. Under current assumption, it still runs to 121, but it's only guaranteed to 90. So, maybe that's an acceptable trade-off. There's an index product, and there's a bunch of index products that do this, but this particular one that I ran at 5%, the premium is about 10,702, and it's guaranteed to age 92. So again, you're giving up that guarantee from 92 and above, but you're also inside these bridge products, you have cash value along the way. And with that cash value, that gives you options. You have options to, surrender the policy and take money back. You can 1035 into a new product. You can borrow it, pay it back. I mean, it's just like a regular contract. And again, those affect the guarantees slightly, but that's something you can't do with a GUL. So that's the last bullet on the slide. It talks about the fact that a bridge product gives you potential cash value that can help with emergency needs.
Hey, Ed, let me jump in here for a minute. I mean, there's a lot of advisors, and there were a number of Forum 400 meetings where there was a lot of actions from a few carriers that had COI increases on their current assumption products, and I just want to address that because a lot of what I hear from advisors is, I don't trust the insurance company. I want to pay that $11,993 because if I pay it every year, they can't mess with that guarantee, right? They can't increase the COIs because the COIs everything is bundled up and guaranteed.
Right.
If you have a guarantee to 90, whether it's on that IUL or UL chassis, you're going to have a guarantee at least out to your life expectancy. But an IUL versus a UL has a floating rate, right? It's not, they both have floating rates, but at the end of the day, you have to make sure you're monitoring it a lot closer because you're going to have some zeros and some caps and so on as you go down the path. What we saw in the current assumption product rate increases on the COI increases a few years ago from a handful of companies or so was really driven off of those current assumption products that were issued 15, 20 years ago that had 4% minimum guaranteed interest rates. And the companies had no more levers to pull. The interest rates had gone down so low that they couldn't even offer what their guaranteed rate was. And they were paying the minimum guaranteed rate of 4%, 4.5%, sometimes even higher. I own a policy, a current assumption policy, there's a 5.5% guaranteed interest rate. I mean, you just can't find those anymore. No. So the point is that, we saw this wave of COI increases from a few carriers, and everybody said, I don't trust the insurance companies anymore. I want to go GUL. And we had that for a long time. Now we've got, I don't foresee a whole lot of motion on COI increases anymore. So having a guarantee to 90 and doing some policy monitoring and making sure that you're managing the policy according to the the original illustrations. And you've got a number of carriers that are also providing some services that monitor the policy for you, depending on what the interest rates are. I mean, that's going to be a lot more active management process, but you've got support from, third parties like a Performix. We had a webinar with them a week or two ago. And then you've got some companies doing some of this in-force illustration stuff to help us out. So I think you got to make sure that, as prices continue to go up, and I can pretty much guarantee you the GUL prices will probably continue to go up for a while, that if you're going to migrate to these UL or IUL current assumption products with long dated guarantees, you've got some options there. And they're certainly a lot more forgiving because of the cash value, to your point, Ed, to do some catch up and do some adjustments along the way. So, 90, 92 guarantees are probably going to be the wave of the future. I don't know that we're going to see a whole lot of guarantees to 120 anymore.
Sure. No,
at least in the price point that we would like, obviously.
Right. And I agree with that. I mean, you can easily make changes, but I've seen sales with GULs that just haven't gone anywhere because there's no cash value.
Yeah.
People say, well, what happens to my premium? Like, where's the cash? Whatever. So if you can't find a guaranteed product with cash value, your only other step is to go to a product like this. And in what you said and what I just said, this makes a great transition to the next slide, is to take that idea of a bridge product a little bit further and take that $11,993 GUL premium, right? So take the guaranteed premium and drop it into these products. What does it look like? With a UL product, you can extend the guarantee now to 93. And under current assumption at age 100, it projects a cash of about $900,000, in $1 million policy. I mean, the death benefit's going to force it up a little bit with corridor, but that's a great option. And then if you take that IUL at 5%, which again, it's not going to do 5% every single year, but that's going to push the guarantee up to 101. So now we're at age 101, which is probably past life expectancy. And if he's still alive, the client's still alive, that age 100 projected cash is over $1.3 million. So, I mean, I look at it and say, well, yeah, you lost 20 years of guarantee, but that's from 101 to 121, and at the same time, you're putting cash in this contract, giving the client options. So it's just something to think about. And again, we can model this when we're running your cases. We can add these in just to look at it. But that's been a popular idea with these IULs over the years, is just throwing in that GUL premium, seeing what it does.
Yep. Good point. And I have to tell you, I mean, if you look at mortality tables and demographic studies, very, very few people live over age 100.
Yeah.
So, you know, when you're losing the guarantees out there, and you know what, look, the reality is that they're saying that, you know, the first person to get to age 150 has already been born, right? More mortality is going to continue to go, life expectancy, I'm sorry, is going to continue to get longer and longer, but, you know, not in our lifetime.
Yeah. All right, and then we'll finally say, no, don't forget about whole life. You know, I've said this on a presentation that I did a while back, a couple of weeks ago, talking about whole life, and we still quote it. I mean, I quote it almost daily. And probably everybody's seen a whole life or they've written one over the years. And it's not going to win a case with the lowest cost. It's not going to be the lowest cost from premium, right? But again, its benefits are that it has guaranteed cash, projected cash, an increasing death benefit, and it could be possibly vanished depending on how you design it. So it's not as flexible as UL or IUL, but there's still a ton of options when you're building it up front. I mean, there's 10 pay, 15 pay to 65, you know, level, high early cash value. There's tons of variations of this product. And it's just important to know that when you're shopping the premium, you know, IUL and UL always going to win. You know, it's always going to have a lower cost. But if you're looking at the values, you know, from that guaranteed column to the current column, that whole life is really hard to beat. And that's just something to keep in mind. And there are carriers that are changing the way they're doing this, the 7702 versions. I'm interested to see them. But as of right now, no one's come out with one on the whole life chassis. So we'll have to see what that does. But that's going to be an interesting look, I think, when it does come out.
Hey, Ed, we had a comment and a question here about, you know, and I answered one live. We typically, the question was, can we mention carriers specifically? I mean, we tend to hesitate calling out specific carriers on these kinds of presentations. But the follow-up comment, and thank you, Steve, for your comment here, is the problem with current assumption plans that we have to trust the carrier to not implement higher mortality expense charges up to allow maximums. I mean, I kind of addressed that a little bit, you know, and Steve, I don't know if you were on, but yeah, there's going to be an issue of trust. And for those of us that have been doing this a long time, we have seen those challenges. And sometimes it's too late to do any remediation. When you get a 100% or a 50% COI increase on a client, all of a sudden the premium goes up by 300%. That's a real challenge. I think those were primarily focused on those older current assumption products that had those high interest rate guarantees. And when I say high, I mean 4% is high in today's environment, right? So it's because they had no other levers to pull. I don't disagree with you, Steve. I think we've got some challenges and we need to be mindful in doing our jobs and looking at these things. I don't really foresee massive COI increases on new blocks of business as we go forward because the interest rates are so low already and products are being priced for that. So, you know, we can talk about that offline if you'd like. Yeah. And thank you for your comments.
Yeah, no, and I mean, again, you are putting a little risk into the contract by not fully guaranteeing it. But the idea is that sometimes, you know, those premiums are out of line, or maybe that carrier didn't make the right offer, or, you know, there's trade-offs. But again, in knowing the whole fact pattern of the case, we may be able to take one of these other types of products and build in that full guarantee. You know, like what would that index product cost if I wanted to guarantee that out to 120? Maybe I can run that number. Maybe it's an extra $500. I don't know, but that's things that we can do in the conversation and what you feel is the best fit for the client. So yeah, we could definitely look at a bunch of different things. So it doesn't have to be a bridge product, but sometimes premium does come in, and also just the design of it. You just can't make it work with the GUL by itself. All right. So presentation isn't only about looking at products available for new underwriting. You know, product type applies to your conversion options as well. You know, every year a term policy, it comes up as an option to reach out to your client. It's a great way to discuss a possible chance of converting that into a permanent product. I mean, some agents choose to do this at an annual review, and I know others that really just kind of wait until they run into that end of that 10 or 20 year period, and then they decide to, you know, grab an illustration and show it to the client. But I mean, as an agent, you know best what your client is looking for. You know when the best time to reach out to them is. You know, the downside of having these conversion requests come in at the end of the term period is sometimes you don't have time to look at all the options. You don't have time to underwrite the client, to give them another choice, or to present something that may be better. But it, you know, so that's something that I just feel that sometimes waits to the end, and I maybe think that the agent just says, hey, I just run an illustration right before this lapses and just see what they want. kind of thing. But doing the homework or even those annual meetings ahead of time gives you a better feel for what they're going to do or what they may want to do when that conversion comes up. So, let's cover a few possible reasons on why someone may want to convert early as opposed to waiting at the end, right? There's a bunch of life changes. You have maybe a new job or pay raise, a projected future estate need. They want to add a rider, possibly a long-term care rider. There's an inheritance or a mortgage or a health change. I mean, there's just a few of the options. There's probably tons more that come up. But, if a client has an in-force term policy and you want to do a conversion, I mean, they're not always as simple as they used to be. I mean, back in the day, you had a certain window to convert and carriers gave you all of the options they had up until the last day. They had their full product line available for conversions. But as they obtained more experience with that conversion book, they started to make changes. And some of those had different windows, right? So before showing a conversion, you need to know the details. The first thing you have to know is what's available for the client. Can they use any product? Do they get a specific conversion only product? Second, will the conversion product meet the client's need? If they want a cash value income design, is that what's available? What if they want that LTC rider? Is there a way to do that through the conversion with some minimal underwriting, or do they have to underwrite a whole new policy with everything? And third, and this goes along with that, is the client insurable? Because you want to have that option, because when we show some of these examples going forward, you're going to say, man, those conversion products are probably not going to be the best fit if the person's insurable. So it's just important to know the underwriting, and you may have to say to the client, you might have to go through this to get the things that you want on your policy.
Hey, Ed, let me take another second on that one, because I think it's important to know, about 5 or 7 years ago or so, I remember the insurance companies pretty much all had conversion options, and, you convert to any product they offered in their portfolio, and that was their current practice, right? We started to see, let's say 7 to 10 years ago, companies coming out with conversion only products and beginning to limit and restrict conversion availability to product specific issues, putting some timeframes on them. We see 4 years, we've seen 7 years, we've seen 10 years, but rarely do we see for the full period of term conversion anymore. Some of them do it as a current practice, and some of them contractually guarantee it. It used to be that we would recommend term products from a couple of specific carriers because in their contractual language, they allowed a conversion by contract to any product offered by that carrier at the time of conversion and for the entire term duration. That barely exists anymore. And what we're seeing more and more is very restricted term conversions for a very short period of time, call it 7 to 8 years, sometimes less. And then if you go beyond that, you can convert, but to whatever conversion product they offer. Now, if you go back to the conversion statistics that Ed mentioned, the only people that convert at the end of their term period is probably because they're sick. They cannot re-underwrite, and the experience of the insurance companies has been terrible on their conversion blocks. It's very expensive for them to convert something and have somebody die a year or 2 or 3 later. So because they've paid a new commission and all that kind of stuff. So at the end of the day, we're going to continue to see restriction on conversions. And I would just caution you to make sure you're asking questions about conversion privileges. Check with Ed Stark or Craig or Hervid in our office, and make sure that if you think there's going to be a permanent need for your client, make sure you're well aware of what the conversion privileges are. We had recently some issues with a company that had, the kind of a little bit of a surprise, because there was a 4-year conversion opportunity to any product, and then it was to only their conversion product after that period of time. And that policy series started in 2017. So 2021, we're 4 years later, and a bunch of people were scrambling to try to do conversions. Now, early conversions are good. I mean, we encourage those because they're not because a client is sick. But once you get that beyond that conversion period, you're very limited in terms of your options on conversions. So just be mindful of that, is all I would say.
Gentlemen, we have a question that's pending about conversions that would be timely to be answered right now.
Okay, I'll read it. Garrett, thank you. Are carriers still offering extended conversion option as a rider, or is that also going away in favor of the narrowed path to designated product? Ed, maybe you want to
I'll
talk
take
about that.
that.
I know some companies have introduced extension conversion riders and just they charge a premium for that.
Well, so there's a couple carriers that I can recall that when you purchase that rider, it went from any product, it went from a specified product to any product. So that's one type of rider, and they might have called that extended conversion option. But the majority of the carriers right now that I'm thinking of, that have these extended conversion options, they don't extend the product choices, but what they do is they extend the deadline. So for example, and I don't have the specifics in front of me, but there'd be a carrier that may only offer 15-year conversion on a 20-year product or 13 years, but you can then purchase this rider to actually have the full length of the term covered up to age 70. And there's a couple carriers that they do that. They call that extended conversion. But I'd really have to do a little more digging. I mean, I know there's a carrier that has two product lines. So they have one, which is their ultra low cost term that has a very limited window. Like I think it's 8 years on a certain duration to any product. And then it goes to a specified product, or you could pay extra on the second product, which would let you convert to anything for that duration. So there's different ways to do it. And again, if that's important, it's worth the conversation, because sometimes those carriers on the spreadsheet, instead of being 1 or 2, they might be 5, like right down the way. They might be $30 more depending on the age or what you're looking at. So it doesn't change much, but it's just something that it may not be the super top lowest cost deal out there. It's just we can talk about.
And all too often, I mean, you get a term sheet, you get a term comparison projection, a spreadsheet, and you say, okay, which is the cheapest? You go down the list, it's this one, and that's what you recommend to your client. And nobody ever takes a minute to stop and think about what kind of conversion privileges does that client have. Yeah. So you may be down to 5 or 6 or 7 on that list of cheapest products. And if you want to get a conversion option that is going to be beneficial to your client. So just something to be mindful of as you go through the term market.
And the other thing too is when you're working with us, I mean, I have certain agents that I work with that I know what carriers they want to see because of what they typically want. They want those extension riders they want the full length at least. And then I had a request just the other day where someone said, show me the absolute cheapest. Conversion's not an issue. Okay, so that's perfect. I mean, at least we're upfront with what we're doing and we're giving everyone the right information. So looking at conversion only products, it's important to know that these products tend to have higher premium costs. They also have lower guarantees and they have less premium flexibility. I recall doing a lot of these where someone might have come out of a 20-year or a 10-year term and you'd run a conversion for another 10 years or maybe another 20 years to make it look like another term policy. And the product would easily price that way. It looked great and it was kind of easy, I would think. But those don't do that anymore. Those types of products typically require minimum premiums that are higher. And some of them actually require annual premium every single year. It might be like a conversion whole life or something like that. So you can't even miss a premium. You can't skip premiums. You can't vanish it. You can't even 10 pay it. You have to level pay all years. So they're a little less flexible. And again, it's important to know that they just can't be designed to do creative things, really. They're just not really meant like that. So if your client's insurable, it's definitely worth looking at. And again, we typically mention that on a conversion saying, hey, is your client insurable? Do you want to, maybe get an informal, have someone look at that? So you at least look at the option to go with that. So on the next slide here, I want to compare a projected conversion only product to a fully underwritten option here. So hold on a second. All right, so we have a male 52 who has $1 million term policy that was previously issued at Preferred Best. If you have access to a conversion only product, the premium, and this is just in one carrier, it would be $20,302 would be the annual premium. So that would be your $1 million all pay design, runs to age 100 under current assumption, and it'll give the client a guarantee to age 84. If the client is still Preferred Best, we can get a new bridge contract at that carrier, basically for $9,756. So for about 50% less, and we can guarantee it to 93. So we can give them 9 extra years of guarantee with that type of product. So that's one reason, if assuming they're still Preferred Best. Now, if the client's table 4, the cost is still less than that bridge product. So a newly underwritten table 4 product would be $16,293 with a guarantee to age 85. In looking at this too, I could say, well, we could also, if the client could qualify, there's some carriers that might give you a LTC rider with a table 4 rating that would still come in a little bit less than that 20,000. Maybe you would pay that 20,000 for a few years less. There's things you can do with these other new underwritten products as opposed to the conversion only product.
Yeah,
it's
so
important to look at it.
I think the lesson there, Ed, and that's a great example, is even if you think your client is not healthy, 4 tables or better, maybe even 5 or 6 tables, depending on what the numbers and the age are. I mean, what I'm seeing here in your example is, a lot of people say, no, my client's got to convert because they're sick now. Well, even if they're sick now, 4 tables pretty much will ensure the vast majority of the population. And we don't see tons of cases over 4 tables. We see our fair amount between standard and table 4. It's better to underwrite your client, even if you're going to deliver them a rated case, than buying a conversion only product.
Yeah.
Conversion only products make money for one person only, and that's the insurance company.
Right. But I mean, we can do that, and we do that comparison all the time. So it's kind of like, if you're willing to at least look at the numbers, we can run it. And sometimes you get an idea of what the client's thinking, but it's worth looking at it and seeing if it's worth putting in the time for underwriting a case. All right. All right, so talk about converting early with access to any product. And it's just important to know that you have to understand the conversion options of the term product that you're working with. I mean, carriers that allow conversion to any product are becoming, more and more scarce. Many of the top carriers provide windows for that any product conversion, 1 to 4 years, there's 1 to 6, 1 to 8, some maybe 1 to 10. But again, it's important to know that, especially if you're planning on a conversion down the road. And, it's just these specified products that are going to have higher cost later, that's that conversion only product later, and less flexible options. So, I want to show this slide. This is the cost of waiting to convert. So, let's look at a sample case. So if you took a male 45 who purchased $1 million of 10-year term, that premium was $730 a year. And that product can be converted to any permanent product for the first 8 years. All right. So assuming age 50, GUL quote, we run that today, it's $12,371. They have access to any product. Client may want a GUL. It's $12,000 a year. But just so you know, last month, if they did this a month earlier, the price only would have been $10,574. So it would have been about 15% cheaper to buy it last month as opposed to today. So we already missed that window. And that may or may not be a reason for a client to say, wow, these things are changing, I might want to jump and do something now. Or they might try to push it back, right? So if they push it back and we go to the conversion only product, so now we're at that 9th year, we don't have access to everything, we have one specific product, and that product is priced today. So again, you don't know what it's going to look like 4 years from when we were going to do the original GUL quote. But that premium will be about $17,296 using today's rates. So, that's a big jump compared to what they have there. It has a limited guarantee. And again, when you're talking conversions, you guys know this well enough, you can't predict what it's going to be in the future. So you could show it to them and people say, well, show me this year, next year, and the year after. Well, that's assuming that's the same product and it doesn't change at all. And that never happens. I mean, these products are tweaked annually, maybe every couple of years, conversion products. So just important to show that, I think. And if you're doing these frequent meetings, it's things like that that are going to help you to kind of enforce that conversion, or we should be looking at this, or you should consider doing something. If you're really interested in permanent coverage, not to put it off to the end and then say, I'll just pay for it later, because, we've seen some of these examples, and with the way the costs are increasing, you will pay for it later. Yeah.
And just Ed, I know that you and your team for the last several months have been sending out, what we call books of business. So if you've done business with Agency One, we just want you to know that we're looking at this stuff all the time. And I'll give you an example. Last month, as I believe I mentioned earlier, we had a carrier that had a price increase. Actually, this month, they had a price increase of about 17% on their GUL product. And we sent out lists of all the in-force term business for the advisors to call those clients and say, if you were thinking of converting, convert now, because if you convert in June or after the 15th of this month, you will pay 17% more. Those are the opportunities that we're trying to create for you guys out of your books of business. We're going to do the same thing for next month's price increase from the next carrier that's going to increase. And I just see them all kind of falling into line here with price increases. And then also with those options to convert to any product versus converting to a conversion only product, we're going to give you guys a heads up that, you've got a client coming up on their 4th year, their 7th year, their 10th year, whatever that is. If you want to convert, you have a choice to convert to any product. So we're going to be constantly giving you information on what your conversion options are, and should you be taking action with your clients, or at least talking to them about converting so that you can save them some money.
Yeah, definitely. And that's going to kind of bring us to kind of our wrap up here. So, I mean, just to keep in mind that term conversion discussion should definitely be worked into any type of annual review. So you can at least talk about options now and what happens if they wait too long. You know, I think with the way product and prices have been trending, the conversation's helpful. And it's also kind of letting people know more than just, hey, here's your price today. But, you know, we've seen a lot of increases, and, you know, going forward, it might be even more expensive, or that product might not be here. So, you know, it may be able to help motivate someone or help them make a decision early. I mean, like Gonzalo mentioned, we've sent out lists of place term business to our agents when we see product rate changes. I mean, you get the announcement about the change, but then we kind of look at what's been written with that carrier. And if you're in our system, we can send you that list. But if you pay attention to those rate announcements, you may have written some of that business with the carrier on your own. Now, we can help you get that information, but we're going to need some of your information to get it, or we can at least tell you, if we can't obtain it, we can work with you to tell you how to do it. But it's important to say, like, oh, I just saw a rate increase and I wrote a ton back with them like 5 years ago. You definitely want to look at it, you know, because when that changes, it's going to change. You know, and to say that this is kind of, you know, someone might say, well, does that work? You know, is it important? You know, actually, you know, there's a few examples that I can put up here that definitely do. And you can call them success stories, or you can just call them, you know, doing the right thing for their clients. But, you know, we've had an agent that basically saw a GUL product actually getting pulled from the market. So the carrier was saying, we are no longer going to sell this type of product. And they had a huge block of term on that. And they spent a month and a half probably reaching out to every single client that had that term policy just to have a discussion. And from that, I mean, they got 3 conversions. So, I mean, that's great. That's 3 new cases. They did what the client wanted. They got them a GUL product, but they also had the meetings with the other clients. And they said that that's going to work down the road, because now they've touched base with them and they've kind of talked to them, and they got to get in front of them again, and gave them a reason to kind of get back in front of their clients. So, I mean, that's a really great way to get in front of somebody, you know, saying, hey, there's a product change. I just want to make sure you know about this. Hey, how are you doing? Right? Update your records. It's all good. A second one goes along with, like, Gonzalo talking about the rate change announcement. And, you know, so here's another one where we sent this out, the list of term. The agent reached out to a bunch of his clients, and he went and presented a conversion to one of the clients specifically. And the guy he wasn't interested. He said, nah, I'm not. But what the agent got out of that is he got 2 referrals to additional family members. So he got to write 2 policies on someone in the family that he previously was not going to reach out to. And he got referrals from that source as well. So it was just another way to kind of get in there, get more, I guess you want to use the word stickiness, it's on the slide, but that's you know, get more in with your client and the family. It was just a great way for him to get out there and just to reach out. And then the third story, it's basically an agent was Zooming with his client, and he had a business policy, a business owned term that they decided that they wanted to convert. And the client had any option on the table. So he said, you know, they looked at it and said, this is just easy. Let's just take care of it this way. But then he identified a personal need. There's personal insurance that was needed. So that became a new app, a new sale for something totally different. So basically 2 sales out of 1 meeting, which is a great thing. So, you know, just reaching out. I've not had anyone tell me, hey, don't send me this list. It's a waste of time. It really just, you know, I think if it's looked at properly and applied properly, it's just a great thing to do. And again, so in closing, you know, the sales team, it could be Hervid, Craig, myself, anyone at Agency One, we can help you. We can get your information, help you do that review, you know, run the correct conversion product and look at something new if that's the case. And then we can bring in underwriting. So, you know, it's never as easy as just run me preferred across the board. It's let's talk about the client's health, and we can get underwriting on there. We can bring on, you know, Dennis, Jess, or Julie and talk about the client and kind of see what we think that might be obtainable and run the numbers on that and just do a little comparison. So, you know, with that, I just want to say thanks. And, you know, if we have some additional questions or something else that we want to bring up, let me know.
Ed, there was a question, and I had missed this one, and I apologize, David. Your question was projections, ... but aren't you making static assumptions premised on average and not varied market metrics? I think that may have been talking about in-force illustrations on older UL or IULs.
I can take it. And again, we can
Yep.
go deeper with it. I mean, we can go deeper with it too if needed. But I mean, the problem with projections, especially illustrations, is, I mean, really the only one that's going to look like it is right now is the GUL, because there's no flexibility. The rates don't impact it. The bridge products, which is probably what we're talking about, you know, the issues with those are they are current assumption rates, and an index product is going to go from a floor to a cap. So it's going to fluctuate year to year, which is why I kind of threw in there that you have to monitor it. And it's really hard. You can't even really vary the rates too much. Like some carriers only let you make 5 rate changes in the software. So I think the conversation is if someone really points to a bridge product, because especially if they're bulking at premium, you can run it at a lower rate. So you pick, instead of 5, you run the fixed account rate if that's what you want to look at. But it becomes a conversation where if the person really starts digging in, then maybe that GUL product is the fit. You know, maybe that is the best fit. But yeah, unfortunately with an illustration, you're making a pretty much a static assumption the entire way out. And it's really hard. You just don't have the flexibility to do things. But again, what do they say? You know, once you hit print, it's out of date. You know, so it's kind of like that. And the variable ones, again, if you're using a guaranteed variable, it's the same thing. It's just the premium stays the same. It's just the only thing you're hoping for is that higher rate to get more cash. But again, a good thing to do is to always sort of test it. I mean, you can look at the alternate column in the illustration, or you can just pick a different rate. I have, you know, I threw in a scenario early about an agent that did a GUL, and we sent him a guaranteed indexed UL. You know, what we did was we put the money in the fixed account. We didn't even put it in the indexed account. So that kind of took away some of his concern about the index. And it just, you know, the fixed account rate is like 3.75 or something like that. So it was still guaranteed. It just had some cash along the way. So again, that's something we can look at, we can talk about, but it's important to tell the client that, yeah, premiums could go up. They could change, you know, if you have a bridge product, but you always have that guarantee. So.
Do we have any other questions? If not, we'll turn it back over to Kathy.
Thank you, everybody.
Okay, great. Wow, Gonzalo, Ed, thank you. That was terrific. What's coming up next with Agency One? On Wednesday, May 26th at 3 o'clock Eastern Time, Agency One is going to be hosting a webinar where we will be discussing opportunities in the small business market and how to help small businesses secure the financial protection they need to face business risks due to the loss of a key employee, death of an owner, and other critical challenges. Brett Berg, Vice President of Advanced Planning for Prudential, will review with us an interactive small business ebook to help identify the needs of business owners in the 4 stages of the business life cycle: startup, growth, mature, and transition. If you are working with small business owners on new coverage or have small business owners as clients with existing coverage, this is a must-attend webinar. These are my closing announcements for today. If you have any questions or would like additional information, please reach out to me or Gonzalo or Dennis. Thank you for joining us, and I hope that everybody has a wonderful rest of the afternoon and a terrific week. Take care.
Thank you all.
Hope to see you
Take
next
care.
week. Bye.